Now let's begin Part 3 of College-Bound Student Loan Training. If you haven't gone through the other sessions of this training, please follow the links below to the correct video. In this session, we'll be discussing how to navigate difficulties with repayment, including how to help students in default. Before we get started on the details, it's important that you understand the way that the federal government uses two terms, delinquency and default. Both indicate that an individual is having difficulties making payments on a federal student loan, but there are a few differences. Delinquency happens the first month a borrower fails to make a payment. Anytime, however infrequently, a borrower neglects to pay, they are considered to have a delinquent account. Of course, this status is easily resolved. A borrower simply needs to make a payment to their account in the amount of the delinquent payment or payments. Unfortunately, if a borrower remains in a delinquent status for several months, they are at risk of having this delinquency reflected on their credit report, so the sooner the delinquent status is resolved, the better. Default is a bit different. This term indicates that a borrower has not made a payment for a substantial amount of time, and there are serious repercussions for borrowers whose loans have reached this status. A default, if unresolved, will remain on a borrower's credit report for 7 years, and can prevent future financial aid eligibility. Further, if the borrower continues to neglect to make payments, the individual's wages may be garnished, and the federal government may choose to either withhold tax refunds or demand immediate payment of the total principal and interest amounts. There are actually two types of default that may show up on a student's account: technical default and actual default. While the differences between the two are somewhat difficult to understand, it's important to pay close attention, as each has a very different long-term effect on a borrower, and there are very different ways to resolve the issues. Technical default occurs when a borrower has not made a payment for 270 days, and it indicates to the servicer of the loan that the borrower will continue to fail to make payments. This status is a preliminary flag that allows the servicer to begin more intense interventions to bring the loan current, contact the student, and make sure that they get back on track. A technical default changes to an actual default after a borrower has neglected to make payments for more than 360 days. At this point, it's much more difficult to resolve the delinquent loan's effect on the borrower's credit and financial history. Hence, making sure that a student or alum resolves their default before this 360-day mark is crucial. When a student or alum's loan is in technical default, it is relatively easy to resolve, as I stated before. A student will only need to discuss payment options with their servicer to make sure they are able to cover monthly payments. This means that a borrower may choose a different repayment plan, place loans into forbearance, or even consolidate their loans for lower long-term payments. However, once the loan status changes to an actual default, a student must go through the process of something called loan rehabilitation, which is much more complicated. In order to bring their loan to current status when it's in actual default, a borrower must discuss with their servicer the minimum required payment and must make 9 on-time payments over 10 months. Completion of this process will remove the default status from the borrower's credit report and remove all potential penalties. Occasionally, a borrower may decide that loan consolidation is the best option after having one or more loans reach a default status. A student should discuss this option openly with their servicer or a financial advisor before making a final decision. As with the repayment plans, it is important not to place value on consolidation at all. Please only provide students with the facts so that they can make the decision that's best for them. There are a few facts that you can share with a student considering this process. First, the interest rate of all of their loans is going to be weighted to create a new overall interest rate for their new consolidated loan. Their loan repayment term often increases, meaning that the student will pay significantly more over the life of the loan than without consolidation, and they will pay for longer. Also, consolidating a loan often decreases the borrower's eligibility for enrollment in some federal repayment plans. So all of these are things to consider when students are discussing this option with their servicer. Further, it is important to keep in mind as you're discussing consolidation as a default resolution that consolidation does make a student eligible for aid and removes risk of penalties, but it does not remove default from their credit report. This is where it gets a little tricky. If a student is in actual default and has not paid for 360 or more days, and they consolidate their loans, those loans that they consolidated were still defaulted when they were consolidated. So that is showing up on their credit report and will affect their credit for 7 years. If you need some clarification on this process, there's information on studentaid.ed.gov, as there has been for other sessions, so please go and visit that if you need that clarification. Again, I want to reinforce that it's crucial for all of these reasons that a student have conversations with multiple advisors to ensure that consolidation balances both short and long-term benefits before following through with the decision. That was the end of our short information session today. As with before, these are the resources we used in this session. Please feel free to visit them for any more information regarding default, delinquency, or loan consolidation. And we will see you in part 4.